And to unpack this a bit more further for us, so we're now joined by Econometrix Director and Chief Economist, Dr. Azar Jammine, and he joins us now via our video link. Dr. Azar, thank you so much for your time this evening here in SABC News. I mean, good news coming out from the MPC there today, and of course, one would say much needed relief for consumers. What is your take on the interest rates, which we saw being cut by 25 basis points?
I think it was generally expected that the Reserve Bank would cut interest rates. For it not to have cut interest rates in the face of significant declines in inflation in the last few months and expectations of further significant declines in inflation, I think the Reserve Bank would have come under enormous criticism, even from those who have traditionally supported it. So I think it was a no-brainer that they would reduce interest rates. The big question on people's minds was whether they would go more aggressively, possibly, and reduce the interest rate by 50 basis points. It was unlikely that they would do so because traditionally the Reserve Bank has been very cautious. And the argument that they would use was that we cannot be sure that the factors that have contributed towards much lower inflation, namely a strong exchange rate and lower oil prices, would be sustained. Far better to just go modestly now with 25 basis points, wait until November. If in November oil prices are still low and the rand is still quite strong, then they could go with another 25 basis points and feel a little more confident about the situation going forward. What is interesting is that they do forecast significant falls in inflation for the next 2 years, but then in 2026 inflation, there was hardly any downward revision in their inflation forecast. It remained at it went from 4.5 to 4.4%, very close to the midpoint of the inflation target at 4.5%. And that simply verifies the concern that the Reserve Bank has, and that is that so long as the inflation target remains as high as 4.5%, we're not going to get inflation down below that level on a sustainable basis for any length of time. Unless we actually reduce the inflation target and in so doing influence inflation expectations downwards. And that's not going to happen if we stick to a 4.5% inflation target.
And Dr. Azar, a very interesting fact that we also saw today is that this is the first time in 4 years South Africans have seen, the interest rates being dropped, especially by that 25 basis points that you speak of. At the same time, what does it say about the state of the economy and just the climate overall?
Well, it doesn't say too much about the state of the economy because the economy is very weak still. Yes, it's showing signs of improvement. Sentiment has actually picked up since the end of load shedding and the formation of the Government of National Unity. But globally, we are seeing a downward cycle in interest rates, and the Reserve Bank has been part and parcel of that, in line with falling inflation rates around the world. The state of the economy remains weak, and this was mentioned by the Reserve Bank. It's a little better than it was, but it's really not good enough yet to get excited in terms of creating enough jobs to reduce the unemployment rate and to benefit, to make people feel really a lot wealthier. Yes, lower inflation will help to keep the wolf at bay for a while, certainly, but it's not anything to get too excited about yet.
And of course, when we speak about the repo rate, we always speak about consumers in the country because, I mean, they get to benefit the most when it comes to this. And looking at that, what does it mean, that drop by 25 basis points for South Africans who are in debt?
What it means is for those who are in debt, it means an extra couple of $100 in their pockets, depending on how much debt that they've got. And at the margin, that is welcome, most definitely. But interest rates are not falling back to levels that prevailed during the COVID crisis, which really gave a tremendous benefit to consumers. We still, an 11.5% prime overdraft rate, when your inflation rate is down at 4%, is still a heavy burden to bear for those in debt. Make no mistake about it. And the prognosis is still fairly reserved about the extent to which these interest rates will fall. Most forecasts are that interest rates will not decline much below 10.5% for prime rate over the next year or so. That's still quite a high interest rate to bear. So, for goodness sake, consumers must not go on a huge borrowing spree on the assumption that interest rates are going to fall by 3, 4, 5% in the next few years. That's unlikely.
And earlier on, I mean, you touched on the fact that, this was expected. A number of analysts talking about the fact that we should at least expect, a 50% drop there in the basis points. One would also ask, you spoke earlier about the Reserve Bank being cautious. And this is what we are always told, that they need to be cautious when they look at, the interest rates. Why not drop it to those levels? If, many in the sector were talking about the fact that, well, maybe we could expect these repo rates to be dropped by 50 basis points.
Because they don't want to get egg on their face in the event that suddenly, say, the government of national unity breaks down and the rand goes back to 1920 to the dollar. Suddenly we're back to the races and inflation's up at 6% and they are forced to hike interest rates back upwards again. Rather be cautious right now. And even if things are not quite as favorable in 2 months' time as they are right now, they will not need to go back and increase interest rates again. By being cautious this way, this gives them leverage in which to move downwards as and when they feel more confident about the sustainability of inflation being very low. And let's face it, talk to the man in the street and ask him how scared he is of oil prices and petrol prices shooting back upwards again. The fact is he is very scared of that. And so too is the Reserve Bank. And they mentioned geopolitical factors that could, for example, cause oil prices to surge upwards again, and many other commodity prices, the same thing. And then you suddenly have a renewed burst of inflation and are forced to raise interest rates. By limiting the extent to which you're reducing interest rates, you try and contribute towards a kind of a stable environment where you don't have to move interest rates massively from every 2 months.
And how long can we expect this cutting cycle to stay around for? Can we expect it to continue on this path even in 2025?
The general expectation is that this cutting cycle can continue for another 1 percentage point. And in fact, if you look at the Reserve Bank's own quarterly projection model, its own model forecast for interest rates is that they will decline by another 1% over the coming year, but not more than that. And linked to that is the fact that and causing that caution is the fact that their forecast for 2026 is for an inflation rate of 4.4%, which is precisely where it is right now. In other words, they don't see inflation coming down that much more on a sustainable basis. Yes, in the next few months, I think and they mentioned it, inflation will be below 4% in the 3s for a while. But then, with electricity tariffs rising by 11% per year in their forecasts, with rates and taxes and other government entities raising tariffs by 8, 9, 10%. That's what is limiting the inflation. And public servants wanting 12% pay hikes. You're not going to get inflation coming down in such circumstances. And the real problem is that when you've got a 4.5% inflation target, that tells you, that almost forms the minimum expectation of what inflation is going to be. And under those circumstances, you can't expect interest rates to fall much, much further than current levels.
All right, Dr. Azar, thank you so much for your time and for that insight. That is Dr. Azar Jammine weighing in there when it comes to the interest rates. Of course, so we saw the MPC making that announcement earlier on today, being cut by 25 basis points.